Hi, welcome to our next session of Venture and Capital. Today we have the founding partner of Alium Capital, Rajeev Gupta. Welcome.
Hi, how are you?
Now we've obviously known each other for some time. So just as a bit of background, can you give a bit of a quick introduction to yourself and Alium?
Steve, I have always been involved in technology. When I graduated from university, I joined Goldman Sachs and was with them for 12 years around the world, in Asia, the US, and back in Australia, investing in various technology companies, public and private. We had the lucky fortune of investing in Alibaba. I was the most junior person on the team at the time, and that did very well for the firm. After I had done that for the period that I did, I moved into a client of the firm, investing public and private technology globally again. And then after that, thought that I wanted to build a technology firm, thought I'd be equipped to do it. And as it turned out, it was 1,314 days of significant pain. We made a lot of mistakes.
I like how you counted every single day.
Yeah. And I'll tell you, I'll get to why it's critical. It was people mistakes, product mistakes, customer mistakes, lots of different mistakes. But we ended up getting it right after about a year of hacking. And 1,314 days is important because that is when we sold the business off. So we were lucky to have strategic investment. And that precipitated my move back to Australia with my wife and 4 kids. And I felt that the ecosystem in Australia was still nascent when it came to technology. And we are not a venture firm and we're not a private equity firm. We sit straddled in between both, whereby we call ourselves a crossover technology investment firm. We invest in both public and private assets. And the ultimate goal of Alium Capital today, which manages just under $300 million, is to find businesses and entrepreneurs that do want to pursue an ASX listing over time. And the reason for the importance of that in our view is technology as a percentage of the index here at home and on the ASX is still only 15 to 17%. When we started the firm, it was 6%. In the US today, it's 70%.
And what year did you start the firm, just for context?
We started the firm in 2015. So we're almost 5 years old.
Okay. Yeah, because I remember, when did Freelancer list? Was it like 2013?
Yeah, I think it would have been thereabouts. Yeah, it preceded.
Because that was the main move. That was the first real move that I saw that really basically kicked off the trend. And obviously then it was the Perth brokers doing a whole bunch of backdoor listings of technology companies, and then, away it went.
Absolutely. And it also then amplified good businesses that were listed. The likes of Altium and Appen that had been around for many years were coming to the forefront of these are technology business that have got traction and they've got a lot of history. So now on the ASX, I think it's close to 250 companies in technology are listed. There's still a lot of concentration amongst the top 20. And Afterpay has elevated and shown to young companies, you can list at the right time if you're early, if you're in a good segment with high growth prospects. So since our inception, we've had around 15 companies go public. The bigger ones have been Nitro, Aerometrics, Damstra. We're Incredible, which got purchased post-listing by News Corp. So we've had reasonable success, but I still think it's very early for us. I strongly believe the portfolio that we have today with the likes of Koala, Eat Club, Cash Rewards, I hope that we will look back in 10 to 15 years and we would have been early investors in some great Australian technology companies that are listed.
And, for me, obviously, I was, you invested into one of the companies which come through WI, which was fantastic. And they're about to go through their own exit, not on the ASX specifically, but obviously in Canada. And for me, it's been fascinating watching their journey. And I'm curious to you, like when you first started investing sort of in this space, what was your approach? And then how have you seen that change over the last sort of few years?
So when it comes to technology investing, there's 3 things that we look at. And this is what it was at inception. It's what it is today. And I don't think it will change. We'll probably add to the quiver of what we look at. So for us, the most important is people. So we look at the team that is running business, and they must either have the skill themselves from a technology standpoint, or surround themselves with people that are deep technologists. If you look in the US, Google, Microsoft, Facebook, Apple, all the people that run these amazing businesses, we're all technologists. They understand what they're building. They know how to scale. They know how to architect, and they know what the customer wants. So people is the first most important thing for us. The second is the product. Often some people will come with products that are in very competitive markets, that are in markets that don't allow you to build a moat. And that for us is a differentiator. You want to be able to build something whereby you can show differentiation, because if you can show differentiation, you can get pricing power. If you get pricing power, you can get reasonably high margins. And if you get high margins, you end up being profitable. Ultimately, in this day and age, it's about revenue, 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 but we do spend a lot of time on the product to understand if you can build a successful, profitable business as well. The third and final is price. So there's 3 P's, right? People, product, and price. It's hard to justify some listed companies' valuations today. Some Australian listed stocks are the most expensive in the world, trading on revenue multiples of, almost triple digit. But that's probably due to this strong retail market and institutions wanting growth, growth, growth. However, we're very price sensitive. I mean, we have seen in the last 3 years, 1,200 companies. We've only invested in 13. So we haven't been that active. So less than it's a 1 in 10 ratio. 1 in 100 ratio. 1 in 100 ratio. You've got to kiss a lot of frogs.
You certainly do.
So we meet a lot of businesses. We talk to a lot of businesses. You get confirmation bias. You learn something from everyone. So never say no to a meeting. That's something we never do. But we are very sensitive as to what we pay for a particular product. And as some of the greatest investors say, price is what you pay, value is what you get. That's the camp we fall into.
And you mentioned about the sort of 1 in 100 approach. Now, how was that in your first 2 years? What did that number look like?
So in the first 2 years, we were probably, instead of 1 in 100, it was probably 1 in 30.
Yeah.
So we were much more active. We were a lot smaller. We were trying to build a reputation. We wanted to be seen as someone that was helping the ecosystem. So today we have a total portfolio of about 40 private companies, and we're very comfortable with that level. We're still doing a lot of meetings even during COVID and post-COVID remotely, and now more physical meetings are taking place. I get no sense that the ecosystem in Australia is slowing down. We are renowned for some of the greatest inventions globally with Wi-Fi, with IVF, with Google Maps, so many amazing businesses. I think Australia will continue to build amazing businesses, medium to longer term. We will continue to meet lots of people that are either too early, that don't have a moat, or are too expensive, but we will also see the counter as well.
So you mentioned as one of the 3 Ps, you mentioned about specifically product, right? And you obviously tied in product and pricing. So surely with that, there's also a connector, which is obviously the typical, the sales process that a company will go through. What are you looking for when a company is building a product and you're sort of looking at the sales process they take? Are you looking at B2C companies or B2B companies typically?
We're agnostic. We look at any business, all businesses. What we try and stay away from are businesses that are asset heavy and capital heavy, right? So if there's a fixed asset or there's some type of hardware component to a business, we're less interested in it, only because it's harder to generate a return on that in our view. Until you become much larger. And to get much larger, you require a lot more capital. So those are segments that we are less interested in generally.
So with that, then how does someone like Koala fit into your investment thesis, and what sort of attracted and appealed to you about their model?
So we met Koala 3 years ago. It's now one of the largest portfolio assets that we have. This business, whilst they started in mattresses, they now have 20 different products. And they're not a capital intensive business. So these guys do not have manufacturing. They do not have warehousing. Koala in many ways is a pure design and marketing company. So they design all their products. So they design the bed base that requires no Allen key or screwdriver. It's all clipped together. The work from home desk is identical to that, right? So it's all clipped together. Marketing is all done with themselves. They have created their own logistics software. So today you've got this business which is in Australia and Japan, and they're growing to expand in Korea in early 2021. It's a business that's annualizing, almost $250 million of revenue, and it is profitable. So it's amazing that two boys from Byron Bay have built this business now, which is trying to penetrate APAC, not only from a mattress standpoint, but from a bedroom, lounge room, storage, kitchen, study. They're trying to own the home.
Incredible. And for you, like, as you're thinking now, you mentioned about sort of COVID, and obviously it's topical for every discussion, but what are you looking at now as far as the key sectors of interest for you from the investment perspective?
So we haven't changed, like I was saying, we still look at everything, and we're looking at various segments. We're not saying we want to pursue something just because of COVID. We had e-commerce businesses going in. We had work from home, asset light productivity businesses going in. We continue to meet more and more of them. But as you would expect, the businesses that are benefiting out of COVID are now trying to raise capital, and they're at elevated levels, right? So the momentum is behind them, and they're trying to capture that momentum, which is absolutely fair, and they should do that because their businesses will only get stronger. But we remain disciplined that you must have valuation parameters that you remain within.
You mentioned that you've got 40 portfolio companies now, and I think you said you've had 15 companies that have exited. That's an incredible ratio, and I don't think there's any other sort of investment groups I know that have got that sort of ratio of, like, if you're looking at a total of 55 companies and having 15 exit and still involved in 40. What are the keys that you said, you mentioned you're looking for companies that are looking to do that. What have you seen that the founders have done right in that sort of lead up to the IPO process that have really helped them, I suppose, continue being successful after they're listed?
Yeah, it's a really good, it's a good question, and there are various answers to this. So let me give you some data points, Steve. So for us as a firm, the reason why we've had a reasonable number of exits out of total investments is that's our core focus, right? So we are investing in businesses that would like liquidity on public markets within 2 to 3 years. We do not invest in businesses that want to raise money from US venture capital. That suits a lot of founders, suits a lot of companies, but doesn't suit the money that we want to deploy, right? So we're focused on people that do want a liquidity event on the ASX. With regards to that preparation, it's a romantic notion to be an ASX CEO, and a lot of people take it for granted. There is a certain individual that can do it, right? So you are public market scrutiny. As you think about going public, there are several elements and facets that you need to be thinking of. You need to build relationships with the investment banks very early. Right. And I was
going to say, you must have investment bankers and corporate finance and brokers all over you.
Yeah, they do. And they're important to the ecosystem, right? They want to do transactions and deals. They're also very important tactically for companies because they can help them with M&A. They can help them find people, etc. So we are trying to, we are immersed in that ecosystem, and it requires all of us to work together effectively. But coming back to the specific question, so you need to have those relationships with banks and brokers, advisors. You need to have a very strong board of directors that does have commercial experience, that has compliance and governance experience, and has some ASX experience. You need to have audited results, which sometimes people take for granted. And then most importantly, this has become a more acute issue in the last 12 to 24 months. You've got to have a very strong senior leadership team, an SLT. Some companies that are listed, you meet the CEO, sometimes they don't even have a CFO. And if they don't have a CFO, sometimes they don't even have a head of sales. There are some listed companies that have 5 people in their business, and the listing costs must be grossly burdensome to them. So we would like to see more focus, early preparation in the business, in people, in the board, in the auditors, in strong legal counsel, etc. So there's so many facets. It's a non-trivial exercise. And right now, Alium's involved in 4 companies that are going public between now and year end. And it's taking a lot of our time, but we're excited for the businesses and the founders.
Now, I think this is probably going to be, I've got two questions to sort of finish up. You mentioned people, product, and pricing, I think was the 3 Ps. Okay. There's one other part that I was surprised you didn't mention, and it specifically relates to IPO and it combines it. How do you help in the decision of the timing for the activity of an IPO and also the timing of your investments? Because timing is so influential in the Australian market and the sort of performance that you, like, for example, I've made a joke. I haven't put it anywhere, but I made a joke in some article that I wrote about how if you just add paid to the name, that it seems to help skyrocket your pricing at the moment, right? So how does timing relate to your thinking and the timing of going to IPO with your investee companies?
Yeah, there's 3 key elements to that. So number 1 is the business ready? Does the business have all those things that I talked about early? If you don't have those elements of board, a clear market strategy, ability to show profitability in your model over time, the auditors, etc., you're not ready. All those have got to be in place. You can't be backtracking to get them done and saying, hey, we're going to list in a month. It's just not possible. I mean, the Australian Stock Exchange says the soonest you can list is somewhere between 16 and 20 weeks of preparation. And that preparation requires years of work in advance of it, right?
Yeah.
So that whole process of the IPO is 16 to 20 weeks, but you need to be thinking about a year in advance. So that's number 1. Number 2, we think there are 2 windows to go, and they're probably in that Feb to May period, which is pretty good. People will come back from holidays before year end. You only go through 1 reporting season. And then the other window is September to November, seems to be a pretty strong time frame to go again. And we saw even yesterday, September, Lay-By, which was one of the companies that we are holders in, that went public yesterday and did really, really well. So those are the 2. That's a second area. So around timing, I'd say those 2 windows. On the businesses and for our portfolio specifically, there's got to be a willingness by the banks specifically to reflect to us as an investor and to the business, which will be public, that there is appetite, right? Yeah. We have seen in the past that you can sometimes you can be too early and sometimes you can be too late. And if you hit either the too early or the too late, it ends up being an unsuccessful transaction. So you've got to take guidance and counsel from the banks and brokers because they see the market, they see the investors, they can see the capital pipeline. So their counsel and guidance is critical. And, we often listen to what they say, and so do the companies.
Good advice. And just for the last question, I always love to ask this as a sort of finisher. If we're having a conversation 5 years from now, how do you think, how can I put this? Because you're slightly different. We're having a conversation 5 years from now. What do you think you're seeing in your world? Like what sort of technologies do you think are the ones that have been the shiners? What sectors have experienced the most growth? What is it? And obviously everything's been accelerated over this last 6 months, but if we're all thinking 5 years from now, what does the world look like from your perspective?
I think it'll be a much more digital world. Take this conversation as an example. If this was happening in 2019, you'd do it in your office or in my office. We don't need to be interacting with each other physically, right? And so I think that is what will happen in a professional context, in a social context, and it will accelerate. We'll have better tools around, we've got VR, we've got AR, we've got mixed reality. Those components, I think, become much more important as time goes by, because it's all about convenience, right? So the reason commerce has taken off is it's convenient. I don't need to buy pet food from Petto or from Woolies or Coles. I can just get it online because I am indifferent to what I'm buying, but I know what I want to pay, right? So I think commerce just accelerates significantly. I think there's a lot more with that mixed reality component in commerce. And I was reading something today that one of our companies is deploying internally. It's involved in e-commerce, and it's talking about video commerce. So you can be watching a show and then you can purchase a product that's shown in that show, which we've heard about in the past. They tried it in Terminator. They tried it in Terminator, but the tools weren't quite ready and it wasn't a seamless experience. Now with integration from mobile to web to your house to logistics to payment, there are so many things that can be done. So I think there's a few different things that we'll look back in 5 years. Number one, I'm not sure anyone will have an office space per se. There'll be an aggregation space that we go to hang out occasionally and have meetings. I think shopping centers will become centers to display products and maybe for pickup if you don't want them delivered. Travel will end up being a greater luxury, only because I think there'll be alternates to travel in a mixed reality world that may be able to transpose those same and similar experiences. And then transportation, you and I will not be driving anywhere. I think autonomous vehicles.
That excites me endlessly.
Yeah, it becomes autonomous vehicles will become part and parcel of society and the way that we live. And we shouldn't have to go to do, kids drop-offs or go to sport on Saturdays. There should be a robot doing it for us. We should be going if we really want to go and be involved and participate.
Rajeev, thank you very much for your time. I know you've got a schedule back to back like mine is. Mate, really appreciate your insights. And, I said, I've enjoyed watching. I think when we first met, you had about 80 million under management. So to hear you got 300, it's been incredible to watch your growth and how your sort of presence in the ecosystem and the impact you've had with the companies you've invested into. So thank you.
Oh, Steve, thank you to you and the team at WI. It's been a great relationship. Hopefully we do a lot more going forward and go technology.
Agreed. Thanks, Rajeev.